There's a strange, almost invisible law running underneath the economy, and once you see it, you cannot unsee it. The law is this: the less money you have, the more you are charged for the exact same things. Not metaphorically, literally. The same loan, the same gallon of gas, the same can of beans, the same car insurance, priced higher, the poorer you are. Economists have a dry name for it: the poverty premium, the hidden surcharge for the crime of not having enough money. And the cruelest part is the loop. Being poor makes everything cost more, and everything costing more keeps you poor. A British author named Terry Pratchett explained it better than any textbook ever has, with a story about a pair of boots. So today, let's follow the money and watch exactly how it costs more to be poor. Imagine two people who both need a pair of work boots. The first person has money. He buys a $50 pair of good boots, the kind that stay dry and last for 10 years. The second person only has $10, so he buys the cheap boots, the ones that leak and fall apart within a single season. 10 years later, the rich man has spent $50 and still has dry feet. The poor man has bought a new $10 pair every year, spending $100, and his feet have been wet the entire time. Pratchett wrote it as Captain Vims's Boots Theory of socioeconomic unfairness back in 1993. The rich are richer, he said, precisely because they spend less. That is the Boots theory of economic unfairness. The man who could afford to spend more ended up spending far less. The poor man was charged a premium, not for boots, but simply for being unable to pay for the good ones up front. And boots are only the beginning. Start with the most basic thing of all, just holding and moving your own money. If you have plenty, a bank pays you to keep it there. Free checking, interest, rewards, a friendly app. But millions of households have too little to clear the minimum balance, or were burned by overdraft fees, and end up with no bank account at all. So they pay to cash a paycheck. They pay for a money order to cover the rent. They pay a fee just to load a prepaid card. The FDIC counts millions of American households with no bank account at all. A check casher might skim 1 to 3% off every single paycheck just to turn it into cash. Each fee is small, a few dollars here, a percentage there, but stacked across a year, simply accessing your own wages can cost hundreds of dollars. Wealthier people get paid to store money. Poorer people get charged to touch it. Same dollar, opposite price, and it gets much sharper when that dollar has to be borrowed. Everyone has emergencies, a blown tire, a medical bill, a short week. If you have good credit, you cover it on a card at maybe 20% a year, or tap a line of credit and barely notice. If you don't, you walk into a payday lender, and the price of that same emergency explodes. A typical payday loan can carry an annual percentage rate in the neighborhood of 400%. Borrow a few $100s to make it to Friday, and the fees can rival the loan itself. Most borrowers can't repay in 2 weeks, so they roll it over and over, sinking into a debt that grows faster than they can climb out. Regulators found the bulk of payday lending fees come not from one-off loans, but from people trapped in 10 or more loans a year. The trap is the business model. The person who can least afford it pays the highest interest rate in the entire economy. The premium isn't a glitch in the system. For these lenders, it is the system. Now widen the lens, because the premium is hiding in the ordinary stuff too. Buying in bulk is cheaper per unit, but bulk requires cash up front, a car, and a place to store it. So the poorest buy the tiny, expensive sizes. The giant warehouse store sits out by the highway. The corner store with higher prices on everything is the only one within walking distance. Whole neighborhoods are food deserts, where the nearest fresh groceries are miles away. So the cheap, filling option nearby is often the processed one that costs more per real calorie. Need a fridge or a bed, but have no savings? Rent-to-own will happily deliver it for 2 or 3 times the sticker price, paid weekly. And here's one that feels almost unbelievable. Your car insurance depends not just on how you drive, but on where you live and your credit. Investigations have found that in many places, drivers in poorer, often minority neighborhoods are quoted higher premiums than safer on-paper drivers in wealthy ones. A spotless driving record can still cost more to insure because of the zip code printed on the form. There is one more premium, and it's the most invisible of all. It's paid in time. When you have money, you solve problems instantly. The dishwasher breaks, you buy a new one, the problem is gone. When you don't, every problem becomes a project. 3 buses to a job interview. A whole day off work, unpaid, to sit in a government office. Researchers call the mental toll of this a kind of bandwidth tax. Constant scarcity eats up attention and measurably lowers your ability to plan ahead. In one famous study, the same farmers scored noticeably lower on thinking tests before harvest when money was tight than after when their pockets were full. Same people, just more worry. So the very condition of being poor makes the long-term, money-saving choice, the good boots, harder to even think about, let alone afford. You're taxed in dollars and taxed again in hours and taxed a third time in the sheer mental space it takes to stay afloat. Poverty isn't just a lack of money. It's a tax on money, time, and attention all at once. So why doesn't competition just compete this premium away? Partly because serving poor customers genuinely carries more risk and smaller transactions. So some of the extra cost is real. But some quietly becomes a lot because these customers have the fewest alternatives. When the corner store is the only store, it sets the price. There's also profit in it. An entire industry, payday lenders, check cashers, rent-to-own chains, exist specifically to harvest the poverty premium. Researchers have actually put a number on it. In the United Kingdom, studies estimate the average low-income household pays hundreds of pounds extra a year purely for being poor. And the people paying it have the least time, the least political power, and the least ability to shop around or fight back. So the premium sits there year after year, hiding in plain sight inside 1,000 small, reasonable-sounding fees. It is not one villain. It is a structure, one that quietly bills you for being broke. So step back and see the whole machine. We tend to imagine the cost of something is fixed, that $1 is $1, and a boot is a boot. But the price you pay depends enormously on the cushion you're standing on. The same item costs more when you can least afford it. That's why the gap between getting by and getting ahead is so brutally hard to cross. It's not just that you start with less. It's that you are charged more the whole way up. The good news is that this is a design, not a law of nature, and designs can be changed. Basic bank accounts, caps on payday rates, fairer insurance rules all chip away at it. Some places already prove it. Free basic accounts, postal banking, nonprofit lenders, and interest rate caps have each shrunk the premium where they've been tried. But it starts with seeing the premium at all, noticing that 2 people buying the very same thing are handed 2 very different bills. So the next time something seems weirdly expensive for someone who has so little, remember the boots. The cruelest tax of all is the one you can only afford if you already have money.